Most traders don't fail because they lack a strategy. They fail because they lack the courage to execute it. You've been told you need a better system, better indicators, better signals. That's a lie. The market doesn't reward intelligence, it rewards discipline. It rewards those who can act when fear is screaming and hold when doubt is suffocating. Today, I'm not giving you another nice strategy. I'm giving you a playbook, a brutal, no excuses framework that forces you to trade like a professional. If you can follow it, you might finally break free from inconsistency. If you can't, then no strategy in the world will save you. So the question is simple: are you ready to trade differently or stay exactly where you are? Discipline over strategy sounds simple, almost obvious, but it is the single most misunderstood principle in trading. Most people come into the markets believing that success is hidden inside a perfect setup, a secret indicator, or a refined entry technique. They spend months, sometimes years, jumping from one strategy to another, constantly searching for certainty. What they fail to realize is that nearly every strategy can work under the right conditions, but almost no strategy will survive poor execution. Discipline is what turns an average system into a profitable one, and the lack of it is what destroys even the best ideas. Discipline means doing what you said you would do, even when every part of your mind is trying to convince you otherwise. It is easy to follow rules when you are calm, detached, and not emotionally invested. It becomes incredibly difficult when real money is on the line, when a trade moves against you, or when you see an opportunity that doesn't quite fit your plan but feels too good to miss. In those moments, your strategy becomes irrelevant. What matters is whether you can act according to your predefined rules or whether you will give in to impulse. A disciplined trader accepts losses quickly because they understand that losses are part of the game. They do not hesitate, they do not negotiate with the market, and they do not hope, they act. On the other side, they allow winning trades the space to grow instead of cutting them short out of fear. This is not about being right or wrong. It is about following a process consistently over time. Without discipline, even a strong edge becomes meaningless because it is never applied the same way twice. Discipline also requires patience. There will be long periods where the market does not offer high-quality opportunities. Undisciplined traders feel the need to be constantly involved, forcing trades out of boredom or frustration. Disciplined traders wait. They understand that not trading is also a decision, and often the most profitable one. They are selective, and that selectivity is what protects their capital and keeps them aligned with their edge. Another aspect of discipline is emotional control. Fear, greed, and frustration are always present, but disciplined traders do not let these emotions dictate their actions. They acknowledge them, but continue to operate within their framework. This is not about eliminating emotion, which is impossible, but about not allowing emotion to interfere with execution. In the end, discipline is what creates consistency. It bridges the gap between knowing what to do and actually doing it. Strategies can be learned, copied, or even bought, but discipline has to be built. It is developed through repetition, self-awareness, and a willingness to hold yourself accountable. Without it, nothing else matters. With it, almost everything becomes possible. Execute without hesitation is where most traders break down, not because they don't know what to do, but because they hesitate at the exact moment they're supposed to act. You can have a clear plan, a defined setup, and all the evidence in front of you, yet when the time comes to pull the trigger, doubt creeps in. What if this one fails? What if I'm wrong again? That split second of hesitation is enough to either miss the trade entirely or enter too late, turning a good opportunity into a poor one. The market doesn't wait for your comfort, it rewards decisiveness. Hesitation is rooted in fear, and fear usually comes from past pain or lack of trust in your own system. If you've taken losses recently, your mind tries to protect you by delaying action. It feels safer to wait for extra confirmation, to second guess, to analyze just a bit more. But that safety is an illusion. By the time you feel comfortable, the opportunity is often gone. It's about being prepared in advance and acting when your criteria are met, regardless of how you feel in that moment. A professional mindset understands that any single trade is relevant in the bigger picture. When you truly accept that losses are part of the process, hesitation loses its power. You stop treating each trade like it has to be right, and instead you focus on following your edge repeatedly over time. Execution becomes mechanical. If your setup appears, you act, not because you are certain of the outcome, but because you are committed to the process. There is also a cost to hesitation that many traders overlook. Missing trades damages confidence just as much as taking losses. You watch the market move exactly as you anticipated, but you're not in it. That frustration builds, and the next time you may jump into a trade impulsively just to avoid missing out again. Now you're no longer trading your plan, you're reacting emotionally. One moment of hesitation can lead to a chain of poor decisions that have nothing to do with your strategy. Executing without hesitation doesn't mean being reckless or impulsive. It means you've already done the thinking before the trade appears. Your rules are defined, your risk is controlled, and your criteria are clear. When the moment comes, there is no need for further debate. You either have a valid setup or you don't. If you do, you execute. If you don't, you stay out. The decision is binary, not emotional. Building this level of execution requires repetition and trust. You have to see your strategy play out enough times to believe in it, and you have to hold yourself accountable when you fail to act. Every time you hesitate, you reinforce the habit. Every time you execute correctly, you strengthen discipline. Over time, this becomes your default behavior. In the end, success in trading is not about predicting the market perfectly. It is about showing up and executing your plan consistently without letting fear interfere. The market offers opportunities, but it does not wait for you to feel comfortable. You either act when it matters, or you watch from the sidelines while others do. Cut losses instantly is one of those principles that everyone agrees with in theory, but very few apply in practice. The moment a trade goes against you, your mind starts negotiating. You tell yourself the market will come back, that it just needs a little more room, that exiting now would lock in a loss you're not ready to accept. This is where discipline is tested. Because the truth is simple, the longer you hesitate to cut a losing trade, the more damage it can do, not just to your account, but to your mindset. A small loss is manageable, it's part of the business. A large loss, on the other hand, is often the result of inaction. It comes from refusing to admit you were wrong in that moment. The market doesn't care about your opinion, your analysis, or your need to be right. It moves according to its own logic, and when your trade is no longer valid, your only job is to exit instantly. No hesitation, no second guessing, no hope. Hope is the most dangerous emotion in trading when it comes to losses. It convinces you to stay in trades you should have exited minutes ago. It whispers that turning a loss into a win is just around the corner. But hope is not a strategy. It is a delay mechanism that allows a small problem to grow into a serious one. Professional traders don't rely on hope. They rely on predefined risk. They know exactly where they are wrong before they even enter the trade, and when that level is hit, they are out without question. Cutting losses instantly also preserves your ability to think clearly. When you hold on to a losing trade, your focus shifts from executing your plan to managing your emotions. Stress builds, frustration grows, and your decision-making deteriorates. You start making reactive choices instead of strategic ones. By exiting quickly, you free yourself from that mental burden and stay aligned with your process. There is also a mathematical reality that cannot be ignored. Large losses require significantly larger gains to recover. If you lose 10%, you need more than 10% to get back to where you started. If you lose 30% or 40%, the climb becomes even steeper. By keeping losses small, you protect your capital and give yourself the chance to stay in the game long enough for your edge to play out. Trading is not about avoiding losses altogether. It is about controlling them so they never become catastrophic. Cutting losses instantly requires acceptance. You must accept that being wrong is part of the process, not a personal failure. The best traders in the world are wrong frequently, but what separates them is how quickly they respond when they are. They don't take it personally, and they don't let ego interfere. They simply exit and move on to the next opportunity. In the end, this principle is about survival as much as it is about profitability. If you cannot control your losses, nothing else matters. No strategy, no analysis, no insight will save you. But if you can master the ability to exit without hesitation, you create a foundation that allows everything else to work. You stay in control, you stay disciplined, and most importantly, you stay in the game. Let winners run sounds simple, but it goes directly against human nature. The moment a trade moves in your favor, your instinct is to protect what you have. You start thinking about locking in profits, securing the win, and avoiding the pain of watching gains disappear. So you exit early, take a small profit, and feel a sense of relief. It feels like success, but over time, this habit quietly limits your growth. Because while losses are often uncontrolled on one side, profits are being cut short on the other. The reality is that strong trading performance doesn't come from being right all the time. It comes from the size of your winners compared to your losers. If your losses are small but your profits are also small, you're stuck. There is no real edge. Letting winners run is what creates asymmetry in your results. It allows a single strong trade to outweigh multiple small losses, and that is where consistency begins to build. The challenge is psychological. When you are in profit, fear doesn't disappear, it changes form. Instead of fearing loss, you fear giving back what you've already gained. Every pullback feels like the beginning of a reversal. Every pause in momentum creates doubt. You start questioning your analysis, your timing, and your decision to stay in the trade. This is where most traders exit, not because their setup has failed, but because their emotions have taken control. Letting winners run requires trust in your process. You must define in advance how you will manage a profitable trade, whether that's through trailing stops, key levels, or market structure. The decision cannot be made in the heat of the moment. If you leave it to emotion, you will almost always choose safety over potential. And while safety feels good in the short term, it prevents you from capturing the larger moves that make a real difference over time. There is also a need to accept uncertainty even when you are right. A winning trade does not move in a straight line. It will fluctuate, pull back, and test your patience. If you expect perfection, you will exit at the first sign of discomfort. But if you understand that movement is part of the process, you can stay in the trade longer and allow it to develop. This patience is what separates those who take small gains from those who capture meaningful trends. Another important aspect is detachment from the money itself. When you focus too much on the profit floating in your account, it becomes harder to hold the position. You start thinking in terms of what you could lose instead of what the market might offer. By shifting your focus back to the structure of the trade rather than the money, you reduce emotional interference and improve your ability to stay disciplined. In the end, letting winners run is about giving your edge the space to work fully. It's not about holding blindly or refusing to take profits, but about resisting the urge to exit prematurely out of fear. Small controlled losses combined with extended gains create a powerful dynamic that supports long-term success. Without this balance, even the best entries and strategies will struggle to produce meaningful results. Control emotions ruthlessly is not about becoming emotionless. It is about refusing to let emotions dictate your actions. Every trader feels fear, greed, frustration, and excitement. These are natural responses to risk and uncertainty. The difference is that undisciplined traders react to these emotions while professionals operate through them. They feel everything, but they do not allow those feelings to interfere with execution. Fear shows up when a trade moves against you or when you're about to enter a position. It whispers hesitation, encourages delay, and makes you question your plan. Greed appears when a trade is going well, pushing you to overstay, overleverage, or abandon your exit rules in search of more. Frustration builds after losses or missed opportunities, leading to revenge trading or impulsive decisions. Excitement, often overlooked, can be just as dangerous. It convinces you that you've figured it out, causing overconfidence and careless risk-taking. None of these emotions are the problem on their own. The problem is acting on them without control. Ruthless emotional control starts with awareness. You need to recognize what you are feeling in real time, not after the damage is done. When you notice hesitation, ask yourself whether it's based on your rules or your fear. When you feel the urge to hold a losing trade, identify whether it's logic or hope. This level of awareness creates a gap between emotion and action, and that gap is where discipline lives. Preparation plays a key role in emotional control. If your rules are clearly defined before you enter a trade, you reduce the number of decisions you need to make under pressure. You know your entry criteria, your stop loss, and your exit plan. This structure acts as a guide when emotions try to take over. Without it, you are left making decisions in the heat of the moment, and that is when emotions are at their strongest. Another critical element is acceptance. You must accept that losses will happen, that not every trade will work, and that uncertainty is part of the process. Many emotional reactions come from resisting these realities. You feel fear because you don't want to lose. You feel frustration because you expect consistency without variance. By accepting the nature of trading, you reduce the emotional charge behind each outcome. Controlling emotions also means managing your environment and habits. If you are trading when you are tired, stressed, or distracted, your ability to stay disciplined weakens. Small factors outside the market can amplify emotional responses inside it. Professional traders take this seriously. They treat trading like a performance activity that requires focus, energy, and mental clarity. There is also accountability. You have to be honest with yourself when emotions influence your decisions. It's easy to justify a bad trade after the fact, to create a story that makes it seem logical. But growth comes from recognizing when you broke your rules because of how you felt, not because of what the market showed. This honesty allows you to correct behavior rather than repeat it. In the end, ruthless emotional control is what protects your edge. You can have a solid strategy, clear rules, and good analysis, but if emotions override them, none of it matters. By staying aware, prepared, and accountable, you create consistency in your actions. And in trading, consistent actions are what lead to consistent results. Consistency beats brilliance is a concept that challenges one of the biggest illusions in trading: the belief that success comes from being exceptionally smart, finding perfect trades, or making bold, high-impact decisions. In reality, trading is not a game of occasional brilliance, it is a game of repeated, disciplined execution. One great trade means nothing if it is followed by a series of poor decisions. What matters is not how impressive your best moments are, but how reliable your behavior is over time. Many traders chase brilliance. They look for the perfect entry, the flawless analysis, the trade that will prove they understand the market better than everyone else. This mindset creates pressure. It makes every trade feel important, every decision feel like it must be right. And when that expectation is not met, emotions take over. Mistakes compound, discipline slips, and performance becomes unpredictable. Brilliance is exciting, but it is unstable. Consistency, on the other hand, is built on simplicity and repetition. It means following the same process every day, applying the same rules, and managing risk in the same way regardless of recent outcomes. It does not rely on guessing or outperforming the market in a single moment. Instead, it relies on executing a proven edge again and again, allowing probabilities to work in your favor over time. It may not feel impressive in the short term, but it is what creates sustainable results. A consistent trader understands that not every day will be profitable and not every trade will work. They are not focused on winning every time, they are focused on behaving correctly every time. This shift in focus reduces emotional swings. Wins do not lead to overconfidence and losses do not lead to panic. Each outcome is simply part of a larger sequence. By staying grounded in the process, they avoid the highs and lows that disrupt performance. Risk management plays a central role in consistency. By controlling position size and limiting losses, a trader ensures that no single mistake can cause significant damage. This creates stability. It allows them to stay in the game long enough for their edge to play out. Brilliance often involves taking larger risks for bigger rewards, but this approach can quickly lead to large drawdowns if it goes wrong. Consistency prioritizes survival and steady growth over dramatic gains. Another important aspect is routine. Consistent traders develop habits that support their performance. They review their trades, track their behavior, and make adjustments based on data rather than emotion. They show up with the same mindset each day, prepared to execute rather than react. This routine creates a foundation that reduces randomness in their actions and improves decision-making over time. Consistency also builds confidence, but it is a different kind of confidence. It is not based on being right. It is based on trust in your own process. When you know that you can follow your rules regardless of the situation, you no longer depend on external validation. You become self-reliant, and that stability reflects in your results. In the end, trading rewards those who can do the simple things well over and over again. It is not about moments of brilliance that stand out, but about the quiet discipline that no one sees. While others chase perfection and big wins, the consistent trader focuses on execution, control, and patience. And over time, that steady approach outperforms even the most impressive flashes of brilliance.